Welcome to the International Derivatives Market course. We will explore the world of derivatives and their importance in the global financial market. Together, we will learn how these financial instruments work and how they are used by various market participants. To quote Warren Buffett, derivatives are financial weapons of mass destruction, carrying dangers that, while now latent, are potentially lethal. This emphasizes the importance of understanding these complex financial instruments and using them responsibly. In this first module, we will delve into the fundamentals of derivatives. We will begin by defining derivatives and discussing their origins. Next, we will examine the four main types of derivatives: forwards, futures, swaps, and options. Finally, we will analyze the role and importance of derivatives in the global financial market, including their advantages and disadvantages. Derivatives are financial instruments that derive their value from an underlying asset or a group of assets, such as stocks, bonds, commodities, or currencies. They have been used for centuries, dating back to ancient civilizations, where they were employed for risk management and speculative purposes. In modern times, derivatives have become an essential part of the global financial system, facilitating transactions, improving market efficiency, and allowing participants to manage various types of risk. Let's take a closer look at the four main types of derivatives. First, forwards are customized contracts between two parties that agree to buy or sell an asset at a specified price on a future date. These contracts are tailored to the specific needs of the parties involved and are traded over the counter, or OTC. Second, futures are standardized contracts traded on exchanges that involve the agreement to buy or sell an asset at a specified price on a future date. Futures contracts are subject to clearinghouse rules and regulations, providing a level of transparency and security not found in forwards. Third, swaps are agreements between two parties to exchange cash flows over a specified period. These contracts are often used to manage interest rate or currency risk. For example, a company may enter into an interest rate swap to exchange its fixed-rate debt payments for variable-rate payments, or vice versa. Lastly, options are contracts that grant the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price before or on a specific expiration date. Options can be used for various purposes, including hedging, speculation, and income generation. Derivatives play a vital role in the global financial market for several reasons. First, they allow market participants to hedge against fluctuations in asset prices, interest rates, or exchange rates. This risk management function is essential for businesses and investors who need to protect themselves from adverse market movements. Second, derivatives contribute to price discovery by providing valuable information about future asset prices based on market participants' expectations. This process helps improve the efficiency and transparency of financial markets. Lastly, derivatives enhance market liquidity by facilitating transactions and allowing participants to buy or sell assets quickly and easily. Increased liquidity benefits all market participants by reducing transaction costs and ensuring that assets can be traded at fair prices. Derivatives serve various purposes in financial markets, and we will discuss three primary uses. First, hedging allows market participants to protect against adverse movements in asset prices, interest rates, or exchange rates. For instance, an exporter who is concerned about currency fluctuations may use currency options to hedge against potential losses. Second, speculation involves using derivatives to profit from anticipated changes in market conditions. Traders may take on leveraged positions in derivatives, hoping to benefit from price movements in the underlying assets. Lastly, arbitrage entails exploiting price differences between related assets or markets to generate risk-free profits. Arbitrageurs may use derivatives to capitalize on discrepancies in asset prices across different markets or between related financial instruments, such as cash and futures markets. This arbitrage activity helps keep prices in line and contributes to overall market efficiency. There are three main types of market participants in the derivatives market, each with their objectives and strategies. Hedgers use derivatives to reduce or eliminate risk associated with fluctuations in asset prices, interest rates, or exchange rates. They often employ derivatives as insurance policies against adverse market movements, ensuring that their businesses or investments are protected. Speculators, on the other hand, take on risk in the hope of making a profit from anticipated changes in market conditions. These participants may have a strong belief about the future direction of an asset price, interest rate, or exchange rate, and they use derivatives to capitalize on their predictions. While speculators can earn substantial profits, they also face the potential for significant losses if their predictions are incorrect. Finally, arbitrageurs exploit price discrepancies between related assets or markets to generate risk-free profits. They play an essential role in maintaining market efficiency by ensuring that prices are consistent across different markets and financial instruments. Derivatives offer several advantages to market participants. First, they provide an essential risk management tool by allowing participants to transfer risk to those who are willing to bear it. This risk-sharing function enables businesses and investors to focus on their core activities without being overly concerned about market fluctuations. Second, derivatives contribute to market efficiency by facilitating price discovery and improving liquidity in financial markets. Their widespread use helps ensure that assets can be bought and sold at fair prices with minimal transaction costs. Additionally, derivatives offer flexibility by providing a wide range of instruments tailored to meet the needs of different market participants. From customized OTC contracts to standardized exchange-traded instruments, derivatives can be adapted to suit the specific requirements of various users. Lastly, derivatives provide the ability to control a large position with a relatively small investment, amplifying potential gains and losses. This leverage can be advantageous for traders and investors who have a strong conviction about the future direction of an asset price, interest rate, or exchange rate. While derivatives offer numerous benefits, they also have some disadvantages that market participants should be aware of. First, derivatives can be complex instruments that are difficult to understand and value accurately. This complexity can lead to mispricing and mismanagement of risk, resulting in significant losses for market participants. Second, the use of leverage in derivatives trading can lead to large losses if not managed properly. Leverage amplifies both gains and losses, and participants must carefully manage their positions to avoid excessive risk. Lastly, the interconnected nature of derivatives markets can lead to financial contagion if one counterparty defaults on its obligations. Counterparty risk, or the risk that the party on the other side of a transaction will fail to fulfill its obligations, is a significant concern in derivatives markets, particularly in OTC. In conclusion, let's summarize what we have learned in Module 1. Derivatives are financial instruments that derive their value from an underlying asset, and they play a critical role in global financial markets. They help market participants manage risk, contribute to price discovery, and enhance market liquidity. We have discussed the four main types of derivatives: forwards, futures, swaps, and options. Each type serves a unique purpose and offers different benefits and risks to market participants. Furthermore, we have explored the various purposes of derivatives, such as risk management, price discovery, and liquidity enhancement. We have also examined the different market participants involved in the derivatives market, including hedgers, speculators, and arbitrageurs, each with their unique objectives and strategies. As we move forward in this course, we will delve deeper into each type of derivative, exploring their characteristics, pricing, and practical applications. Thank you for joining me in this first module, and I look forward to continuing this journey with you as we explore the fascinating world of international derivatives markets.